Good morning, everybody. Happy Monday. Welcome to Pre-Market Prep. Spencer, here's the old
Mic check, mic check, mic check.
Good morning, everybody. Happy Monday.
I'm sorry.
There you are.
What a way to start the
It
week,
was right
Spencer.
up to AM radio.
I swear I changed it. I swear I did.
Change
Anyway,
that.
welcome to Pre-Market Prep. Spencer, Joel, Dennis. What do we do? We're opening down again. We just had 2 down weeks in a row. You wake up this morning and everything is down. Stocks are down. Bitcoin is down. Gold is down. Everything is down. What are we going to do, everyone? That's the question of the day. Make volatility great again. We're going to talk about all of this volatility we're getting in the market right now. We'll talk some vaccine stocks. I wanted to talk about Li Auto for a second later on in the show because they did lower their guidance today. But that'll be later. We got to talk about this volatility. We got Tim Quast on at 8:35 to talk about it as well. We got Matt Hammond to preview the week in IPO land at 9. But man, we got a lot to discuss today because the market is interesting again, and I'm excited for that. So go ahead and smash that like button and let us know what you think of our new graphics because we got some new graphics going on today. You like it? You don't like it? One, if you like it. And I don't. That's all I want to hear. I only want to hear if you like it. If you don't like it, I don't really want to hear that. So all that being said, let's bring up Joel's charts, and you can tell us about the damage this morning, Joel.
Yeah, first of all, I'd like to announce a special event on September 28th on PreMarketPrep.com. 1 to 1:30 exclusive. Gene Munster versus a mystery guest. We're going to cover some great topics. So go over to PreMarketPrep.com and sign up that. Putting together a good list of questions for that. Let's go to the markets. Let's go to the screens here. And we got some major red here. An expiration turn. They were pounding the market in the after hours. The actual close was up at 44.2175. But by 5 o'clock, this thing was 13 handles lower. Not much at 6 p.m. to hold the market up. 43.4850. That is your pre-market low. I have another daily low below that. I'll talk about that a little bit later on, but just trying to find support here in the pre-market, not doing a good job of it. S&P's down 1.56%. Crude, after getting close to 73 yesterday, testing 70, down to $1.73 at 73.03. Gold, beacon of light here. The only green on my front page, up 590, 1757.30. Silver's still in the red by a couple pennies at 23.32. Bitcoin joining the hit parade, down $3,745 at 43,700. Ethereum falling nearly 11% here, where the futures are down $367 at 30.59. Triple D, I mean, can we blame it on the quad witch, often turning points in the market? We talked about the buying balances, and you were saying, no, be careful here. They could flip, and they flipped. A lot of them flipped big time. You just want to talk about that real quick?
Yeah, we'll talk
Friday?
about that. I mean, the media is going to blame this whole thing on Evergrande. That's what I'm just seeing. They always find some fundamental reason. The way it works, and I know this because I have reporters that call me all the time. The way it works is when they see the markets moving, they go and they try to find, okay, well, what's the fundamental? They don't want to hear anything technical. They don't want to hear the market's overbought. They need a headline. I need a fundamental catalyst. What's happened? So Evergrande is going to be the scapegoat here for the sell-off that has been happening here for a while, just quietly. But we knew when we broke down on and you're right, Joel. Friday completely reversal. We opened right up into resistance. There was some stocks actually on Friday, and actually it's Thursday that we opened a resistance. But Friday we were trying to open higher. We were trading, and it looked like we had some buying balances. And then we turned around and we flipped, but there was some wicked opens both ways. So check out this. Check out Berkshire Hathaway where it opened. This is why you should have your orders out. If you want to get out there, even if you're not a day trader, even if you're not an efficiency trader, just having your order out there and ready to rock because you got a day that the SPY was opening down. Berkshire Hathaway at the last second flipped to a buy balance and opened up almost 4 points. This is like a fund. I mean, this is, moves with this high correlation in the overall market. It's buy down, Burke up. And if you look at the chart, can we see, I get confused. I still don't like all these charts. So I'm looking at the top left, I guess.
Yeah.
Yes.
But you can see it doesn't look like much, but we opened at 281 on Berkshire Hathaway on Friday. The stock had closed the previous day at 277.5 on a day we were opening down. So fair value for Burke. I said this on Friday. I was like, this is how we play them. You get the fair value, you offer short, and you offer, and you bid, below that the fair value. And if stock opens too high, you get short. If stock opens too low, you get long. That strategy worked like a charm on Friday. So Berkshire Hathaway, 277.5. Fair value was down like 276. It opened at 281. 281. Came in like you took zero heat. ExxonMobil opened up $1. It actually indicated and looked like it was going to open way down. They flipped it at the last second, and the stock opened up $1 on a day that crude was way down. ExxonMobil straight in. Opening tick high. You short that. You took zero heat. Straight down all day. Nike, another one. Nike opened up $3. $3 on Friday. Bring that one up. And again, opening tick was the high. Straight down, 3 points in about 3 minutes, and then it continued to leak all day. And now, obviously, it's gotten ugly. It does report this week, I believe, on Thursday. You had AT&T opening up 30 cents, Verizon opening down 30 cents. Dogs and cats living in harmony, not really, but I'm just saying those are paired up together. AT&T straight down from the open. Verizon went straight up from that open quickly to try to get back in line because those two stocks pair together. By the end of the day, they were paired right back up together. But those are inefficiencies that, that prop traders take advantage of. Those are inefficiencies that, and you can say, oh, 1%, whoop-de-doo-da-day. But I mean, when you're deploying a lot of capital, you make 1% in 1 minute, it's a hell of a good trade.
I still don't know why these orders are put in. I know they need the opening print. I know they need the efficiency.
Some institution just throwing away
I mean,
a
why don't
pile
they
of money on
just
that
give
open.
us a call or send us an email or something, and we'll save you a couple $1 million on those orders. I mean, holy Toledo! But you talked about it, and similar to the market really tried in the opening couple minutes to rally, and it couldn't. Closed on the lows for the week. We got some follow through. I don't know. I mean, now things are looking a little bit more, a little bit more serious on the downside, because now you got that really a tough area now. You got people that were buying the dip on Friday, right? Because it always works. It always works. Now what do you do? And if you are one of those traders,
it might work again. We're not saying it doesn't work. This is a hell of a dip.
Yep.
Would I be selling stocks into
Nope.
this, heavily? Probably not. I'm just saying what has been working is buy the dip and sell the rip. But if you're just buying the dips and if you're getting to sell the rips, you're not doing very well in the last few weeks because we have been starting to leak here. But I mean, I think you just keep playing it the same way. On days like this, if you're, heavy in cash, if you're on margin, I hate being on margin. I'll just tell you right now, when you're heavy invested on margin, the market, it works really well in an up market. It's really ugly in a down market, though. But I mean, if you're sitting here with extra cash, maybe you're nibbling on some stocks. Maybe you're looking, at what, when we're going to highlight a few names today that still haven't breached their lows from a few weeks ago. But I mean, at the same time, I think sell the rip is working better right now. So the easier trade, and people think shorting is evil, but the easier money has been shorting. Just think about that Friday open. Shorting those opens on Burke and ExxonMobil and Nike. And you know what? You took zero heat. You were up significantly. So what has really been working well lately, maybe better than buy the dip, is sell the rip. But we had that 3-4 days of the same range on SPY. And we finally breached the lower end of the range. And now we get the collapse. They're going to thank Evergrande for that. But whatever, we broke major support. So you had people nervous. You had a weak close on Friday. You come into the weekend and crypto gets beat up over the weekend. There's reasons to take profits. And there is still a lot of profits in this market.
Can I show you the one chart that seems like everyone out there has seen, right? This is a daily chart of the SPY. And that blue line up top there is a 50-day moving average.
Yeah, so we can cut that.
Oh yeah, I was just gonna mention that.
Everybody has seen this chart, right? I know you.
Oh yeah.
But even if you take the purple crayon. So I'm not a big fan of moving averages, but
I
if
know
you
you're
take
not.
the purple crayon, it kind of looks the same.
Yeah.
You know, you're trying to breach, you know. But
Yeah.
are we okay? Is this a fake down or a breakdown? We don't know that yet. Nobody knows. I don't care if you got the most, you know, the trader that has the best track record ever and just knows everything, because nobody knows anything. It's all probabilities. So am I selling, you know, and load? I got to get the hell out now and sell everything on a day we're down 700 Dow points? Oh, I think you're doing it backwards. You had to be selling into the Friday open. And we've said, you know, 3 times last week I tweeted about selling the rip when we were ripping higher. 3 times. Go look at my Twitter feed. So, I mean, the
You know what
opportunities
happened?
to sell were plentiful.
You know what
Plentiful.
happened a lot too last week, and is that we bounced hard. Like we went down into that 44.25, 44.30 area, and on Monday we bounced out of there. On Tuesday we bounced out of there. On Wednesday we bounced out of there. Thursday I
Buy the
wasn't
dip
here,
was
but
working.
I mean it was by and then on Friday, you know, because if you got caught shortening to weakness, all those days you got smoked, right? But finally, it worked on Friday. So we'll
But
see the
but I
Friday,
wanted to
Monday
take the
move
point. So if
follow
you got
through.
caught shorting into weakness, it wasn't working. But if you were shorting into strength in the last week and a half, it's working fantastically. So if you're shorting into today's weakness, it was not working for the last 6 or 7 days. Is it gonna work today? Maybe you get some follow through. Maybe we're gonna have a day we're gonna be down 1,000 Dow points. It can happen, but am I betting on that? Probably not, because you know, more often than not, we still have this mentality that if I buy the dip, I win money. And that mentality, even though we've broken maybe some support, I don't know if it's entirely broken. Now, am I coming in and just buying, you know? No, I'm always trading, and what I've talked about is market neutral, where I'm picking up some stocks, but I might short some index against it just in case. You know, that's how I trade. I play it safe. Why do I play it safe? Because days like this, I can be green on a day like this. In all likelihood, I will be green on a day like this. I don't know, the day's just getting started. But you know, where everybody else makes money when the market goes up and loses money when the market goes down, I make maybe a little bit less money when it's going up, but I make money when it's going down too. So you know, my P&L typically moves up, you know, most days, and that's because I'm trading market neutral and taking advantage of market inefficiencies. You know, picking up a little bit extra, maybe on some sales on Friday morning, where you know I'm picking up some extra. If I had that hedge with an index, I mean, those are ridiculous edges there. So and that's what we're going to talk about when and Joel, we haven't officially announced it yet, but in October we're going to do another webinar because our first one went very well, and we're going to teach a lot of this different stuff. You know, Rob Friesen in there, who specializes in this stuff as too, basket trading. We're going to teach market neutral trading, how to protect your capital.
So let's talk today, this morning, right now, right? Everything is pretty much down. Almost
Yes.
everything is down this morning, right?
Sure.
How do you approach today? Whatever you want to describe it to, you want to say it's because of China. You want to say, oh, there's a big Fed meeting on Tuesday and Wednesday. We're waiting for that. We're waiting for the taper, interest rates, whatever you want to say. Whatever you want to say, why it's here, whatever. Doesn't matter the reason, but like, how do you approach today?
You've got to have your list, and you know, and everybody's list is going to be different, and everybody's portfolio is different. So you can't just take and blanket and say this is what you do. You got to look at your own positioning. I've been sitting with cash. You know, we know that for a while. It's been the wrong move. I moved up to 40% cash 3 months ago because I was nervous that we were just getting overbought. It was the wrong move. We continued to move higher after that. Even though IWM has really gone nowhere since I went to cash, SPY has moved higher. It was the wrong move. So now maybe I'm looking, maybe I want to deploy some of that. Maybe I want to go to 35% cash only. You know, this is from an investing standpoint. As a trading standpoint, I'm looking, you know, at different, you know, what was strong last week? What stocks wanted to go higher in the last week? What is, you know, really looking like it's holding up well? Because those stocks actually are the ones that usually continue to hold up well. So you got to look at individual charts and you find some different opportunities. I mean, Alibaba has not breached its low. So
I
it was good
noticed that.
news.
I
One, you know, we
noticed
can
that.
say how weak the stock is. It's been horribly weak, but I mean, it bounced right where it was supposed to bounce. 152.80, August 23rd, 153.67. You're 154 this morning. I mean, you could take a flyer on that. Stop yourself out for $1.50 here, Joel, if you say the low of the move is going to hold. I played win that way last week. I didn't hold it long through it, but you know, it did have a nice trade overnight in the thing because it didn't breach the low, 82.55. It's going to do it to you today. But you know, there's opportunities. There's different opportunities. in the market. You just got to have the setups. But this is a little bit of a tougher setup. It's like people are licking their chops what to buy. But again, on the first day, I might not be doing as much buying as I might be if it doesn't make a new low tomorrow. Because right now, I don't know how ugly it can get. There's an unknown. There's a lot of money to be made on these days if we just bounce it all the way back, and we might. But if we turn into the Dow down 1,000 type of day, I'm going to lose money on that. So I'm probably going to play it safer today, even though your gut instinct says, oh, I got to buy here because I'm going to make a lot of money. I look at it as like, I don't know how to control the risk here. I need a washout day and then analyze after that. So I'm not just necessarily coming in and hard buying the dip today.
Yeah, and also, I mean, Spencer, you're coming at this, there's so many different perspectives that you can bring in here. If
Right.
if you're a day trader coming in long, right, expecting the normal market activity, well, what was your plan on Friday? What was your exit point on Friday? On based on Monday's information or your own information. If you're coming in short, it's a different story. I mean, you've seen what's happened with, when you've tried to hold on to your shorts too long in this market. From a daily perspective, look at your prior day's lows from Friday. If you're looking for a gap fill, see if they get back up to that area, because sometimes they do, or sometimes some of these stocks are lazy and they just open up. If there's not a heavily traded stock that you're in, maybe there's some latent bids in there, and you can get some decent prices off the open. I think once the open starts, if you start second guessing your decision, so that's for a lot of people, I would just say, hey, if you're long and you've been doing this for a while, take your loss, move on, reevaluate. If you're short, you're hitting a target, cover your target or bring your stop down. I mean, there's a lot of different things. If you're a young kid like Spencer and Mitch and other
I'm,
investing people,
I'm
then
so
I won't say today's per se a buying opportunity, but you have to put your assets in the market when you deem appropriate. For
yeah.
me, I'm heavy cash. I'm staying cash until maybe 2030 or
But
2040.
again, until 2030. But again, if you're young, you can take more risks here too. But is this necessary? I'm going to tell you right now, stocks are not cheap. It's why I raised up. We've just had such a ridiculous run, and we're priced for perfection across the board. Nothing is cheap. Like we had this conversation 4 months ago when I was moving to cash, and it was the wrong move, dead wrong. I was dead wrong to move to cash 3-4 months ago. But I haven't went back in because I just keep looking at it. This is my long-term investment portfolio. Like I said, my RRSP, they call them Canada, it's 40% cash. Its only job is to invest. Its only job is to long-term invest. It doesn't do anything else. It's not money I'm taking to build my house. It's not any of that. Its only job is to invest, and I don't like the values right now. I don't think there is some value in there. Yes, I'm long a lot of General Motors, which hasn't been great. It was good at one time. It's come all the way back down to where I bought it. But I just don't see anything super cheap. And that's why I'm not overly invested. A lot of my RSP is indexed, but I'm just looking, I'm like, we've had such a move. I mean, we are priced just for perfection. And it's the type of environment we're in. We have these NFTs. You go buy Brady NFT. It's like $23,000. I mean, the money out there, there's just a lot of money just chasing any type of asset that they even deem an asset. And I'm not even sure if these pictures on the internet, the NFTs, are assets. I haven't even totally decided that myself yet. And I've been on the fence, and I can kind of understand this, the scarcity, but a picture of a rock selling for $1 million is pure stupidity.
Not for me.
Pure stupidity. So there's pure, and this is my opinion. I don't think the rock, maybe somebody already sold it for $2 million. I don't know. I don't follow it, but it's a hot potato. Eventually that rock's going to drop like a rock.
Dennis, the rock is old news, man. The rock is like 2 weeks ago.
What is it now?
I don't know.
Just something else.
Something
There's
else.
so many people just, and I've said this, and I've went on record saying this. So somebody just tweeted about 2021, and they'll say, well, look at 2021 and see what a great opportunity this was to invest in 2041, 20 years from now. I think that person is wrong. I think everything is very overvalued right now. And I honestly think we could go into a 3 or 4 or 5 year market period where we need to let those companies catch up to the valuations. Apple's against itself. When has Apple been this expensive? Talking against my book, I own Apple. But I mean, it's just not that much that's cheap. Spencer's laughing. He says the market only goes up.
It's not what I'm thinking.
What are you thinking?
I'm thinking it's hard to explain what I'm thinking. I'm thinking that everything you're saying, it makes sense logically, but it's been wrong up to this point.
Oh yeah,
Yeah.
it
So
has.
so
It has. I mean, there's no doubt. Like I said, I moved to. I'd already admitted I was wrong. 4 months ago, I went to cash. Stupid, dumb move. You know what? The market went up after that. But I'm still looking at it and saying, am I wrong or am I just early? So, I mean, I'm not coming in here and just loading up and going on margin because stocks aren't cheap. But am I buying the dip today on certain stocks? Yeah, but I'll be selling short other stocks against it to hedge myself too. So I like General Motors. I'm on the record saying I think GM is cheap. But you know what? Cheap stocks have gotten
Get
cheaper in this
cheaper.
environment. It
the other
hasn't paid off.
the other thing I'm thinking
I
is
like
that,
Pfizer here. Pfizer's a stock, and we got news, and let's segue to that.
Yeah,
There's
let's
good
like-
news from that.
let's
It's
like-
off
Ooh, we're
almost
still
10 bucks.
falling,
It's off
man.
almost
Holy
20%. Pfizer's off almost 20% from the highs now. I'm long Pfizer. I might add to it up here. My cost base on Pfizer is $13. I hate adding because then you bring up your cost bases so much. But I mean, down in the low 40s, I think Pfizer's a good buy. So there's some opportunities here where some stocks are cheap. But if you're just coming in any random stock, Kathy Wood style, and saying growth is there, I mean, it's been a tougher environment. I mean, ARKK's highs back in February, $152 or $159. It's 117. This in 2021 has been terrible for high growth investors. You know, we've had moments where it's looked okay, but it hasn't been good. So does the market turn back to high growth? Maybe, but those valuations are crazy on those stocks.
Okay, on the Pfizer, there was actually two headlines. If you missed it from Friday, an FDA panel voted pretty decisively against approving a approving the Pfizer BioNTech booster shot, except for people with that are at high risk. So anybody who's at a high risk for COVID, FDA said, yeah, you can get it. You should get a booster, but no one else should get a booster right now. That was on Friday. This morning, we have new data from Pfizer BioNTech on their study with children. They said children ages 5 to 11, their vaccine was safe and effective. They also said that we could get data for children younger than 5 before the end of the year. They weren't totally committal on that front, but they said maybe by as soon as the end of the year. Regardless, for now, children ages 5 to 11, Pfizer BioNTech say their phase 2-3 study showed that their vaccine was safe in children ages 5 to 11. So what's next now is inevitable FDA approval of the vaccine for kids 5 to 11. And then when we get the data for kids younger than 5, we'll go from there. But that's the news on Pfizer this morning.
And that's good news for the overall market. Do we see more of a reopening trade come back from that? Potentially. The reopening stocks have had the shit kicked out of them. I'm going to swear. They have. This has been an ugly trade for a long time. We know the casinos and the airlines have gotten ugly. There has been some pockets of strength. Disney has been a pocket of strength because it seems like, heads it wins, tails it wins because they got the Disney Plus. But does reopening trades start to, catch on from the Pfizer? Do we have a sneaky reopening buy here this morning? I'd lean to those stocks with that news because that news is just getting thrown out baby with the bathwater here this morning, but it's good news, because that efficiency, that gets people like me that maybe are staying home still and being a little bit more cautious because I have unvaccinated children. Those kids get vaccinated. I'm like, I can start to be a little bit, do a little bit more of my normal stuff because now my kids are a little bit safer. So there is that mentality out there. I know there's people anti-vax don't believe any of that. That's fine. They're going to have their opinions. I'm of the opinion that because I'm vaccinated, I'm somewhat safer. And because my kids are not vaccinated, that then I don't want to risk them. So I am more conservative in what I do. I would not eat inside a restaurant right now. I would not do it. That's me. I would not do it because I don't want to risk me bringing home the virus, even though I did get sick, and giving it to my kids. So, but you know what? If they get vaccinated, I might start eating in restaurants again because they got a little bit of protection. So that can help. So that's the mentality I'm trying to give you, and thinking that we could have a sneaky reopening trade show up here again because those stocks, actually, some of them are cheap.
How's that Pfizer chart?
Boy, oh boy. Pre-market low, 42.92. That was about 6:15. Got a little pop off here. A lot of red candles on the daily. We got a monthly level to contend with today, and it looks like we're at there right now. So I would love to see this show some support for at least for a day or two in this 43.25 area. That was the low for last month. This month so far, 43.31. We are trading below that. I'd like to see it for me a little bit cheaper. I am long. I think my cost basis bought this a little bit late. I think it's right around here and didn't extinguish it on that crazy rally because it's a longer term hold. 42.5 to 43 looks like a more of like in the next area. You had three lows in the 42.5 area. So if you want to lean on that for a swing trade, but just there's a lot of pressure on this. I at least like to see like a low, a consolidation, then one or two up days in a row. It's just so many red bars here. So first things first, pre-market low is at 42.92, and for me, the extra major supports at the 42.60 area.
Do you know the absolute last thing any Chinese stock needs right now? I'll tell you. It's literally any other bad headline. Literally anything else. And that's what Li Auto is getting this morning. It's got this Li is down. It's got nothing really to do. Well, all China is down, and Li is just pouring a little bit of gas on the fire this morning because they said, "Oh yeah, we're having some supply chain problems and some chip problems, so we're going to lower our Q3 delivery outlook by 2 to 5%." And so, literally any other bad headline is like pouring grease on the gasoline on this fire right now because China's got enough going on as it is. Right?
But they lower it from 10 to 8.
You know, you're not far off. No, you are far off. They lowered their guidance. Originally, they were supposed to deliver between 25 and 26,000 cars this quarter. They said we're going to deliver somewhere in the 24,000 range.
There's such a bubble in all these EV stocks.
How do you invest in that?
I have the Fisker, and I've been punished for having it. It's probably is a bad call. I like it because they have the Magna deal, and I do believe there's going to be some Fiskers out there, but all these EV plays are garbage. A lot of them are just junk. Like, that's my opinion. Obviously, you know, some are going to work out, but I'm going to tell you, like 90% of these, and I'm not saying Li Auto is the one. I don't know. Li Auto, maybe they're making cars, so it's good. But is this like, you know, when you're talking about 25,000 cars, how many does GM make in a quarter? Does Ford make it?
They mistakenly make 20. Like they make 25,000 cars. They don't even know, but they don't even count it. It's like a rounding error for them. 25.
It's a rounding error.
Yeah.
So I don't know. You know, I'm long GM. I'm long Ford. Other than that, and Fisker, which is probably, you know, my speculative EV play. Speculative for sure. Fisker could go to 0. Don't kid yourself. It could. I don't think it is. That's why I'm long it. I think it's going to be one that's going to be one of the EV stocks. But there's so many, man. I mean, you know, we know what Ride's done, but what is there, like 50 of these companies out there?
There's too many.
There's got to be close to 50 at this point.
There's not going to be 50 that are all, and the pie is not that big. So you got everybody trying to eat this pie, but there's just not enough pie for everyone. So there'll be pie for maybe, you know, we know GM and Ford and Tesla are going to be eating the pie, but then it's a matter of how much of these speculative plays going to get of the remaining pie. And which companies it's going to be. It's kind of a crapshoot, really. So it'll be interesting to see. I'm not buying any of these other companies, though, these small ones, just because I can't figure out, you know, how to value them.
Yeah. But at the same time, this is like the one area of China that's like held up relatively okay.
NIO's done okay. It's held up okay. I mean, it's 35 from 55, but it's held up okay. I mean, it was $7 back a year and a half ago.
I know. Anyway, so yeah, China
27s. If you feel like you really have to take it, you know, try and buy the dip on this one. They're a pair of lows at 27. Maybe hold up today. The recent low of the move has been under that at 26.22. But that's what you look at. If you're hoping for a bounce on this thing. 28, get your orders out there near 28.40, 28.50. The bottom of yesterday's range was 28.59. SPOOs are just they're just offered. That's all there is, folks.
Where's the support? Give us a level here. Let's take it back there.
I already had that. All right, I already had to readjust
we took out
once.
The 18th. Where is the next major support?
I have a daily low at 43.39.75. That's a daily low. That's what I had to adjust after they took out my 62.75 low. I don't have anything lower than 43.39.
You're gonna go off the board with your sheets here. If you were
That
handing
was
us out
August
sheets
19th, and I already had to readjust one, so I'm not gonna readjust again.
and SPY, we're significantly below that. That's the beautiful thing, that you don't have to adjust your futures for your SPY. 433.66. It's 3 points below that low. If
Yep.
I'm just looking at the SPY and I don't look at the futures at all, because the SPY is so much easier to read.
Straight down this morning.
Yeah, you think 43, so you think 430. I think we're going to bounce. I think when Dow gets down 1,000 points, if it gets down 1,000 points, there's always a natural bounce there. We've seen this last year during the COVID crisis. It wants to bounce when you get down 1,000. Like, everyone's down 1,000, people sell, and then it gets a relief pop because everybody's always wrong. Yeah, well, that's it. So we're down 700 of the Dow. If I was buying the dip today, I think I'd wait till we're down 1,000. I think we could hit down 1,000 today. And then I think we could bounce a little bit.
Well,
so maybe there's a little
We're
bounce
gonna
trade in
bounce
there.
at some point. I mean, you just don't
But
know if
yeah, we're so overbought. I mean, still, like, we can say that, but stocks are just not cheap. If we were in this environment where everything's dirt cheap, and like I said, I think GM and Ford are cheap. That's why if I was buying stocks and didn't own GM and Ford, I already own them, I'd probably buy those today. You know, here's GM, been holding up very well last week, now down $2 in the pre-market here. I think it's an opportunity. I don't think this chip shortage is a long-term issue either. I mean, they've punished a lot of these stocks because, okay, well, they're missing guidance because they don't have the chips. But eventually they're going to figure that out too. Demand is not a problem here. I don't think demand is a problem for the automakers.
Quick PSA courtesy of Jay Woods, who will be on our show later this week. He's the NYSE floor director. If anyone's forgotten, and I'm just going to throw it out there, limit down is 7%. So we are ways away from that. We are nowhere close.
We're not even close.
Nowhere close.
It's not it. We're not in this. We're not back in the COVID. I don't think we're
No.
going down 2,000-3,000 Dow points here.
No.
And there's the mentality here. Like I said, another 300 Dow points down from here, I'll probably try to nibble into some
I don't
stocks.
think
Have
you
your
can-
list.
I don't
Have
think
the
you
stocks
should.
you want. But if you're buying stocks that are trading 25 times sales, I mean, those stocks can get hit a lot more.
I would just say there is some percentage of the dialogue today online on Twitter that's it's a little bit like tongue in cheek, and I'm a little bit tongue in cheek today because it's like, and as Joel said this the other week, I think it was like it's been like the easiest year, like arguably like ever. Like not in terms of the overall market, not in terms of like growth stocks, but like the S&P. Like it shouldn't
in the term of SPY,
right?
Not even IWM,
right? Sure,
SPY, because IWM's had some 10% corrections.
We just had 2 straight down weeks for the third time all year, which is like insane that's even a thing, right? So it never should be that easy. So there is not all like the freak out is like genuine, because everyone knows that we're due for a correction. We've been saying that for a while. So that's just keep that in mind. Real fast, I wanted to mention before we bring Tim Quast on, and we talk about this all the time.
Tim has warned us about a pending market correction here for a month at least.
Yeah, that's right. He has. We'll ask him about that. But before we get to him, I just want to mention SmileDirectClub. Please don't chase this today, everyone. Okay, this thing got to 824 this morning. We're already down more than $1. It is the most mentioned stock on Wall Street Bets today, and I think also on Friday as well. So just SDC, it's one of the few stocks in the green this morning, but just please be careful. It's already down $1 from the high.
You can do what you want. I mean, this is all just, trading, and we know Wall Street Bets can drive stocks. But like I was saying last week, it seems like when you look at these stocks, the really high mentioned stock, you look at it 3 months later, they seem to be, maybe it's selective perception on my part, but they always seem to go down afterwards.
Yeah.
Like they seem to, the buzz starts to subside after a few days and they start to leak. What was the one we were talking about last week, or 2 weeks ago? What was it? Our SPRT. Or SRP.
It's not even around anymore.
No, SPRT isn't even stocking. What the hell did it turn to?
We already talked about that.
Yeah. Anyways, that went to from 2 to 60.
GREE.
Oh yeah, I bet you they're glad they did that acquisition.
What's IronNet too? They're right. IronNet. What'd that one do? Yeah, look at IronNet here.
Yeah.
So it went from 10 up to 47. That's a quick correction down 28. Well, I don't trade this stuff. I don't like losing 40% of my money in 3 hours. Right. I mean, I'm just not my style. So I'm about protecting capital. I don't know how to do it. would I put, can you speculate on some of the stuff like that? But am I going all in on margin on IronNet or safe SmileDirect? No.
All right, it is 8:36 on a Monday, which means you know what it's time for. Tim Quast, founder and CEO of Market Structure Edge. And Tim, to your credit, you have been you've been doing what you're not supposed to do. You've been right.
I've been right.
You've been right. Yeah, you've been saying that the market is going to go down for, I'm not quite sure how, not that long, but long enough, right? Long enough.
And I said that the worst day of September would be September 20. This is the day that would be the linchpin for the markets would be September 20. And there's a reason, and we could talk about that. But I appreciate you pointing that out. I wrote yesterday to the Edge users the notes out today, but I said, if today is a doozy, then we have more trouble ahead. This will be the fulcrum of what happens to the market. So now everybody will cast about for a reason. I would remind everyone, however, as we look at the steep drop in the futures of what Marcus Tullius Cicero said. He said, if you have a garden,
I was just thinking that.
Right, this always comes to mind, right? If you have a library and a garden, you have everything you need. So there you go. Just kind of puts things in perspective if the market's way off.
All right, Tim, what is the reason in your view?
Okay, so let's make sure that everybody understands that we that we all read and we listen to the various perspectives on what might cause this. And of course, the thing everybody has fixated on is this the financial troubles of Evergrande Real Estate out of China because of its its indebtedness. It's over $300 billion in debt. But you could compare that to the United States. So, right, why not pick that? There was a big Fed meeting coming up on the 22nd on Wednesday. Could be that. So everybody will cast about for reasons, and let's first talk about the cause. Then we can talk about what reasons contribute to that. The reason today is a difficult day is because today new options trade. So if money doesn't show up at the same level to recommit to three particular things: hedges, if you're trading global macro like Bridgewater or what have you, the big hedge funds. Number two, if you're passive money or indexes and you don't use the same level of substitutes that you did before, that's going to be an issue. Number three, if you trade options and futures and you just decide, I'm just going to not do as much as I did. All three of those things contribute to the money showing up on an array, a buffet of derivatives laid out on the 20th, and people don't show up for it. So then everything goes on sale. It's not in some ways, it's not more complicated than that, but you need to understand that almost 20% of market volume rests on derivatives. It's very much like, let's use an analogy so that you can understand this, traders. So as real estate prices keep going up and people are willing to pay more and more for houses, then more houses come on the market at higher and higher prices. And then there's a point, a nexus, where that stops. And by the way, it's stopping all over the country. Here in Steamboat Springs, we're finally seeing price cuts. We're seeing it in Denver, seeing it in Texas. It's happening. And so what happens is the thing that you valued a month ago at this level, you now value it at this level minus 10. Well, the same thing happens to the equity market with derivatives. Derivatives are a right, but not an obligation to do something in the future. Derivatives are implied supply and demand. So if nobody shows up to consume that supply, then that supply is marked to zero and it comes out of market cap. And that's why these periods around derivatives expirations are so important. It's why I like to take my money out of the market and walk around to the other side, which I've been encouraging, which I did myself. That's what I do. I want to avoid these periods because the prudent foresee evil and hide themselves. Now, why is there less demand for derivatives? That's the big question. Well, pick a thing.
I mean, wait. It's only the first day, though.
Well, that's what's crucial. So if you're in the business of moving large quantities of wholesale supply relative to options and futures, and there are banks that do that, then this is a very important day for you. This is the day when you furnish to the market the thing that you expect it to consume at a roughly equivalent rate to what it did back in June. And I looked at all the associated data. So I looked at the composition of the market in June when the options expired the last time and where they are now. And you would arrive at the conclusion, if you're in that business, that we're going to have roughly the same amount of demand. Was there any indication in the data that we might not? Well, yes, there was. There was active selling last week. Interestingly, active money was a seller. And during index rebalances, we had good volume. Volume for the 3 days in the 3 days of expiration. So Wednesday, Thursday, Friday. Friday was the rebalance in SPY, which is a great proxy, was about 270 million shares. Go back and look at it in June, same time period, almost identical. So if you were projecting what the demand might be, you would arrive at the conclusion that it could be very similar. There are only two big differences. Number one, short volume is significantly higher this time. So short volume is supply.
Short volume in the overall market?
Yes.
Okay.
Short volume is over 46% of the S&P 500 right now. That is almost half of all trading volume is coming from borrowed stock. So if you have a lot of supply, and then the other big difference is what we call internally, we say there are no purple bars. Purple bars for us are evidence of counterparties who are going to consume a significant part of that supply of derivatives. Well, instead, we saw active selling. So if you have active selling, you don't have the derivative traders showing up, and you have higher supply, what might the market do? It could go down. So now, how would we know that might happen? Well, I'll show you how we think about this. And you don't have to know all that stuff, traders, because we do. We're going to know that stuff. You know, our job is to make sure that you know those things. And so we'll tell you if this is what the data indicates. So I've gone to Market Structure Edge. This is 2.0, by the way. We've now beta launched version 2.0 of Edge. So I'm going to hit broad market sentiment and just look at this. This by itself should tell us what the trouble is. So here is sentiment, and it peaked right here. So that peak is the 7th of September. That's the point. At that point, heading into when the market is down into options expirations, it may be up the other side, but we're not out of it until we get to Wednesday. So, and why Wednesday? Because there are options that expire. So all the books have to be accounted for there. The debits and credits associated with the derivatives trading. And people don't talk about it enough. That CNBC was actually talking about it this past week. But again, I'll say it's almost 20% of market cap. Okay, and then you have new options trading today. Parties will square the books on those tomorrow. And if opportunists are in the market will go up 600 points tomorrow. I'm not saying it will, but that's where the ledger will get squared. And then Wednesday we will return to reality, and we'll have an idea of where the market actually is. So if this line bottoms by Wednesday, I'd say, okay, we're good. If it's still falling and broad market supply is rising, then we have more trouble. And you remember, this is what I said a week ago. I said, if we have a bad day Monday, then the market could take a big leg further down. We'll see.
But okay, but also, so I know this isn't really your bag, but
Yeah.
Wednesday is when we're going to get the latest Fed meeting. Is they're going to announce whatever they talked about, the dot plot, whatever, right? Couldn't that also throw a wrench in the data you're looking at, because it may change expectations? It
sure could. It absolutely could. And there is a factor that we spend a lot of time looking at, and it's because this factor, the DXY, it is the single most highly correlated input to market performance. We track that. So we do all, there are all kinds of inputs. It's the reason we come back to supply and demand in the market. We've determined that is the biggest. The next thing below that is the dollar. The relative strength of the dollar plays an enormous role in how the market behaves. So if we look at thank you, Market Watch, for this data. So if you look at the dollar, it's trading at about 93.5 now, which is getting very close to a year-to-date high. And so a strong dollar tends to depress the prices of risk assets because the dollar denominates risk assets. Smaller denominator, larger price. Larger denominator, smaller price. So as this trends up, then the risk to everything from stocks to real estate increases, and oil. Energy has performed very well, but energy was a reflection of what happened between options expirations in August and present. The dollar declined. Well, what will happen? Energy stocks were the best performing asset class in the or sector among equities. But now that trend has reversed, and that input will be fed into derivatives. And look at what's the worst performers today. Apache, Occidental, all these things have given up all of their gains of the month, at least now, pre-market. Yeah. And there's a cause. So, and to your point, Spencer, I think you make a very good point, an astute one. And you should maybe listen to Spencer, everybody, and wait to see what the Fed does. I think the Fed is going to look at this and be very dovish because they don't want these things to fall apart. But you never know. You never know. So it's a good reason.
Okay, so the takeaway here is Tim is going to be watching demand for derivatives today, tomorrow, Wednesday, and also keeping an eye on whatever the Fed says or doesn't say with regards to a timeline as far as when they could potentially taper and all that good stuff, because we know we know what's on their minds, but we still don't know when it's going to start.
Remember, though, that the Fed is market dependent and not data dependent. And if the market continues to go down, they will do their best to defend this market. And that tapering talk will quiet in a hurry. So you have to, sometimes the market fixes the whole Fed's issue. And the Fed is stuck. And they're really stuck in a hard place here because they know deep down that inflation seems to be a little more sticky in a lot of areas than they'd like it to be. But they can't come out and flat out say, we've got an inflation issue, because then they have no excuse. They need to raise rates, and they know if they raise rates, the house of cards starts tumbling down. So it's difficult as a Fed official. You're trying to just to manage it, the expectations of, maybe we're going to raise rates here, but we know if we really start to really jack them up, that the whole world's built on debt and everything comes tumbling down. So, I mean, how when you look at this, Tim, and you look at the market selling off, and maybe we're worried about interest rates going higher, isn't the Fed put here to a certain extent, for lack of a better word, kind of like, a possibility that this market just, eventually finds a bottom just because they know the market participants know the Fed's got the markets back?
Well, we'll find out, won't we?
That's true. That's a tough question to throw at you.
Well, I love these pithy little aphorisms, but again, it reminds me of I've used this before, Herb Stein's law. So it's called Stein's law. That's what it's known as in economics. And so Herb Stein, for those of you who are younger, is the father of Ben Stein, well-known economist and writer. And so he famously said, if something cannot last forever, have I got you guys? Something cannot last forever, it will stop. And so, to your point, Dennis, the Fed is in a very difficult position because while it's supposed to be independent, it is heavily indebted to supporting the economic policies of whoever is in charge at the time, and nobody wants markets falling apart. There's just no question about that. From a trading standpoint, traders, what do you do with that? Well, and this will be a little self-serving, but I'm telling you, from having done this for 20 years now and used this data in front of us for a dozen, these they're not perfect, but they do reflect well all of the inputs. Instead of having to wonder, well, what are the hedge funds doing? What are the macro economists thinking? What about monetary policy? What about things in China? How about economic growth? What about the supply of oil? All of these things are inputs that all manifest in this little green line called sentiment. It's measuring all of those. And so look at this. This has been an issue, and I've talked about this before. This issue started in April. In April, we ceased to have a momentum style stock market. It doesn't mean that the consequence arrives right away. So whatever the Fed does today will have a consequence in the future. What the Fed has already done is playing out now in the equity market. And so when the policies began to slow, the input of money into the market in excess fashion began to slow. And we can look at the Fed balance sheet every week. I do. And while it continues to rise, the rate is slowing, right? The rate's slowing. Well, this started back here. So while the market has continued to rise, this is inertia, the continuation of something that has been set in motion. But inertia will slow at some point. And
Joel,
this thing's already telling us, right? It's already telling us.
Joel,
Yeah, Tim, I just want to hop in here with one thing. I mean, we're talking about the open here, and we're talking about maybe what the Fed does, but we know institutional money is what moves these markets, right?
Correct.
And don't you? I mean, I got a monthly chart up here of the SPY, right?
Okay.
And that the move that we've had, discounting even what the March low, maybe that was an artificial low, but even in the activity that we've had in 2021, you're coming up to an end of a quarter here. Don't you think, with everything that's going on with whatever the macro, whatever the earnings, whatever's going on with COVID, that I think that big money is going to be looking much more to sell the rip in this market, or sell, than they are, just because we're always constantly programmed, buy the dip, buy the dip. We're going back to new all-time highs. I mean, why can't the spider go down to 400 or 350 or 300? I mean, we've had all these things. Don't you think that and I don't know how you gauge this, but I think the institutional money, I mean, you're going to have the overshoots on the downside and everything, but I think now you're far away from like the all-time high now. You're coming up to the end of the quarter. I think you have to readjust your thinking. So we got the end of the quarter, Friday's a trading day, and I believe we get it to the end of next month. But what do you use for an indication that, hey, we're just not buying the dip anymore, and we're just selling the rips, or if we have to sell in the weakness, we sell in the weakness?
That's a good question.
So I'll dovetail the two. It's a very good question, Joel, and it's the great existential question for all of us with exposure to the equity market. I'll note that our prognostications about the effect of what we call risk management, derivatives, plays out. So now let me add another piece to this. What you're describing is true for about 9% of trading volume. There are investors who are doing those kinds of things, but they are not the predominant money in the market. There is an Achilles heel to the predominant money in the market. The single largest form of institutional asset management is large cap blend. That is, those are stocks in the Russell 1000 that are can be both growth and value, which, by the way, is Apple. It's Facebook. Those are blend. They could be growth stocks. They could provide the support for growth ETFs. They can be value stocks and provide support for value ETFs. But that is fully 1/3 of all assets under management. And that money wants to track a benchmark. It wants to be the SPY, let's say. So here's the trouble. As SPY deteriorates, that money has no choice but to adjust to it. And that is what creates snowballing effects. It's not that money doesn't buy dips. The money that buys dips is merely excess capital and stock pickers like Ron Barron. Ron Barron is going to, the Barron funds, he's a classic value investor. All the value investors will do what you described, but they're overwhelmed today by a 3-to-1 in terms of volume in the markets by money tracking a benchmark. If the benchmark deteriorates, so must the money associated with it. If energy is 3% of an index and it loses 0.5% of value, 0.5% comes out of the market. If the FANGs are 25%, I'm adding pluses in there, and the FANGs drop 5%, half of that 5% of the money comes out. That's how you get a snowballing effect.
And
right?
this is the double-edged sword of index funds. But that's
exactly.
that's the way things go. Tim Quast, everyone, you can learn more about his site, marketstructureedge.com. You can see his notes and his research and his data there. Tim, always a pleasure to talk to you again.
See you guys
Monday. It is 8:56. We got 4 minutes left before I'm going to talk IPOs with Matt Hammond, and it was a big week for IPOs. So, did we miss anything, Joel? Dennis, chat. What else haven't we gotten to today? Because
let's do 3 minutes ticker time. Give us
some
tickers here.
Let's do ticker time. So drop those tickers in.
I saw Square.
Okay.
We haven't talked Square on the show for probably a few weeks here.
Okay.
It's pulling back. People are looking the natural dip and looking for the growth stocks. Down $10, 4%, down 4%. I would say as long as it holds the low of the move, which is 237.91. There was a washout low with an ugly candle back on the 13th. That's the level that I think Square needs to hold. Before that, Joel might jump into this 245 area, which has some nice support. So there's a couple levels there too. So if you're so inclined to buy the dip and you need to buy the dip in something, there is, the opportunity that the trend is still intact here. What I will warn you is that Square is a very expensive stock. And if we decide to go into a corrective environment where the market starts to lose 10%, Square will get hit really, really hard. So am I buying this dip on today on Square? No. As a trade, if I was doing it, it'd be a quick one, and I'd probably use the 245.07 actually low from the 15th to stop myself out. If I was buying it like right now at 245.70, risking maybe 80 cents.
Yeah,
but it's a tough one. And then you can always look at the imbalance too, which is 43,000 to sell, showing an opening indication of 244.75. So it's looking a little weaker from where it's trading right now.
Dennis, I'll give you the you could give the support and potential buy areas. I'd say I'm for someone that's looking at this, I don't know, on a day trade or longer term. In the 250 handle, maybe not today or tomorrow, but I'd call 250 to 250, 238, 52.38 was low on Friday. That's major resistance. So
you'd rather be a seller of the rip in this.
I'd be a seller on any kind of rip here, not selling it in the hole. Also, look at this monthly chart. You took out last month's low, right? Are you really stepping in here? You've taken out last month's low by $9, and now looks like maybe you're going for more. So really, the only good number I see there is.
Well, you look at that bottom right chart too, Joel. You make a good point. We're $50 back during COVID, and yes, Square is operating, but they're talking about stocks up 400% in just over a year. So year and 3 months. There's some people sitting on some huge gains in this thing. Is it logical that all stocks go up 400% a year? Is it going up another 400% next year? Probably not as easy. So is there profit taking? Is there potential for this to see 200 again? It could happen. Again, remember, Square is also a crypto play to a certain extent, very small portion of it, but it gets a little bit hit harder here because crypto's down today.
Let's do one more quick. Nike, our fan asked about Nike. They report earnings on Thursday. This chart is very interesting.
Someone just wants out ahead of the report here. That's all there is. Trading on the lows of the pre-market session. I don't know, pair of lows. If you're looking for, we're already below that. There were a pair of lows at the 53.60 area, potential support. Bottom of the range from yesterday or Friday, you could very see resistance 156.
All right, it is
one
more. Oh my gosh. Okay, let's do someone that's not.
Just grab any.
3M. I want to find something different.
Wow, that stock's has been hit so hard. This is also margins getting squeezed because of inflation. So we know that that's an issue for a lot of companies here right now. Inflation's an issue for 3M as well. Low of the move, 179.41, which was Friday. We're taking that out when stocks are making new lows. I always say you gotta go. I don't like it because it's making new lows.
You got a chance at a gap fill there. Look at that resistance at 79.41. If it gets anywhere near unchanged, that would be a gift. But on the monthlies here, since you've taken out last month's low by a wide margin, I'd say if you're looking to buy the dip in this one, maybe wait for the 174 area. That was your February and March lows. So we'll hop over to pre-market prep and cover all these symbols that we missed. And Spencer, I'll check in with you later on.
Checking with you later, Joel. Same to you, Dennis. Guys, once again, let us know what you thought of the new graphics today. We're not very good at sticking to a plan on this show. Every day I come to the show with a plan, and every day Joel and Dennis like take my plan, they just toss it out the window. But we stuck to it today, so give us credit for that. And let us know what you think. Share your thoughts in the chat. Shoot us an email, shows@benzinga.com. Let's bring on Matt Hammond, guys. It was a wild week in IPO land. We had a very, very busy slate. We do have some more IPOs coming this week. A lot to talk about. So let's get Matt on from IPO Warriors. Matt Hammond, good morning, sir. How was your week? I bet it was eventful.
Oh, yeah. I mean, you couldn't really ask for more. We'd had a long downtime in the IPO world, and then it just came back with a vengeance. I mean, I didn't even really have time to check much else in my portfolio and was, kind of shocked to come back to the kind of rest of the world and see, oh, the market's down. It's like, what? No, not in the IPO world. And we had nothing but wins. It was almost like everything you played, you were making money. And to the point where I think going into this week where we have another full slate, I think we have, 12 or 13 IPOs this week. I need to kind of focus on just a few so I don't miss some of the ones that I really like locked in. But we can go through a little bit of last week real quick and then jump into next week because there was a lot to learn from last week. The first thing I wanted to say was, I did come up with some, I'm always improving my rules and really distilling things into things that I can really take action. And I've simplified things into 2 rules that we keep talking about now in the trading group. If you come over to our Reddit thread at IPO Warriors, we're live trading these. Every day there's IPOs. And one of the things that constantly comes out is people saying, oh, I wish I'd taken, I wish I'd stayed in longer, but then they do that. And then they miss out on win opportunities. These things drop just as fast as they go up. So one of my first rules is take profits without regrets. And the reason I say without regrets is because it really is a bad habit to get into, to get out with a win and then say, oh, I should have stayed in longer. Because then you start pushing yourself further and further and further into these trades. And then when they drop really hard. I mean, these things come back. You look at Dutch Brothers from last week, which we're not going to look at what happened after, but it made it to a high of 52 and then dropped all the way down to 43. And now you can say, oh, but I sold out at 44 on the way up. It's like, doesn't matter. You took huge profits. You took a 10-point win, in one day, and you missed out on a little bit more. So what? Take profits without regrets, and it's a very strong discipline.
What's the saying? Comparison is the thief of joy. If you can't be happy buying a stock, getting a 10% winner because you missed the top by $20 or whatever. If you can't be happy about that, then you're never going to be happy.
And you're going to hold exactly. And it goes along with bulls make money, bears make money, and pigs get slaughtered.
Right.
The greedier you are, you're going to lose. I mean, my biggest loss should have been a win, and that was Bumble. And I just revenge traded it and took what should have been a $5,000 win and turned it into a $10,000 loss. So take your profits. Don't regret it. Learn to read, what you could have maybe spotted or identified in the way that the stock was moving, or what kind of strategies, maybe a little bit more room with your stop loss, and maybe see where the level 2 orders are and see that kind of high bid pulling the stock further up. Maybe try to see where you can take some extra profits on the next one, but don't push yourself into just being greedy and saying, oh, well, I sold out too early last time, so that's the only reason I'm not going to sell for a profit on the next one.
All right. So
the second rule is don't chase. Once you've missed the trade, do not chase it because you're coming in with a higher price point. And that's another, entry to get into where you're going to put yourself in a position to lose. Okay, I just want to fly through some of the last ones. I don't want to spend more than 5 minutes on this. That'll give us time to work on the next one. Dice Therapeutics, I don't play biotechs usually, and this is a great example of why. Even though it opened at 30, peaked at around 40 on each of the, the opening day, the second day, and the third day. If you look at the price movement here, this is almost impossible to play. If you set any kind of stop loss to protect your downside once you're up, you're going to get stopped out. The volume, the spread, everything was so hard on this one that I look at this and go, yeah, win opportunity, sure, I missed it, but I'm okay with missing this one. This would have been very hard to play, and you'll see why compared to the next one. This is one that I called out as I really like this one. It was Proceps Biorobotics, low flow biorobotic surgery. But given this was, the first IPO we had last week was Sports Radar. It didn't do all that well. Then we had TYRN, I think it was called. It also bombed, and we just had, we hadn't had a strong IPO debut for a long time. So I said, okay, if this goes up on the debut, I'm going to set a stop loss on my debut point. And that ended up stopping me out early, but I didn't lose any money. And I'm okay with that. Even though I had a high conviction in this and I missed out on the opportunity to win here, I took my money back into my account. There were a lot of other IPOs that day, and I was able to put my money into some plays that were kind of safer plays. When there's a lot of IPOs, you want to focus, don't be afraid of protecting the downside where you're not losing money. I don't like to take stop losses where I would lose money, but once I'm up in a position, I will lock in a win or a non-loss to avoid getting in a position where I'm stuck, especially when I want to use that money for plays that are kind of, easier to play. The ones that go straight up off the debut are far easier to stay in than something that's bouncing around. We also hadn't seen how strong the market was during this day. And as the day kind of progressed, my confidence in the IPO plays went up. Definitive Healthcare, this was a huge winner. I passed on this one simply because I didn't quite understand it. And it was the first IPO we really saw of this session, of this kind of slate of IPOs that went straight up, and it started to build my confidence. If you got in on the debut, it was $37.15. I think the IPO price on this was $24.25. So it debuted at a significant premium. And since we hadn't seen anything really blow up yet, I had passed on this one, but it started by watching this one. It gave me the confidence to play, the next ones. And this one, you had outs here. If you want to play the initial spike, maybe take a third of your position out here. If you're, trying to play this as a single day trade, maybe you take out with a trailing stop loss around here. You get stopped out by this candle. If you had a lot of conviction in this, you're going to let it run for day two. The opening day two dip on a huge run up on day one is okay. You hold through that, and then you either put in a trailing stop loss as it climbs here, or you say, no, I really believe that this is going to hit 45, 46. And if you had seen the other IPOs that, had gone live on day one, you would have had a lot of confidence in these IPOs. And if you like this company to begin with, it's not unrealistic to think that maybe you stayed up, through here at a stop loss, or really went, if you held any position beyond that. I think once you see a big number like 50 coming up, it's a good time to take money there. But just another example of one. This is the kind of play that makes it so easy on you, because when it goes up from 37 to 40, okay, you put your stop loss in at 38, sit back, get comfortable, and focus on other trades. Dutch Brothers was kind of the big surprise, I think, for a lot of people.
It's the best coffee in the world, apparently.
Yeah, and I got this is one where I just got distracted. I had a entry order. It was originally showing at indicating at 29 on the bid, 31 at the ask, and I set my entry at 30.85. We did get a little dip off the debut, which would have caught because I was trying to undercut by the ask by about 15 cents. And I got caught watching other trades, getting into other trades. And when they raised the ask to 33, I was literally in the middle of updating my order when this went live. Once it jumped up, I didn't want to chase and kind of kicked myself for missing it. But I took all the proceeds and put it into on and made money on that one. So I can't kick myself too badly. But again, this is exactly what this is the dream setup. It just goes straight up. You're not taking any heat. You can set your stop loss, around here after, you watch it go up. You can take profits at any of these points, but you do want to be taking profits. This is what I was talking about right here. If you got greedy and said, no, it's going to go to 80, it's not going to go to 80 right away without coming back a bit. And if you're in this for a quick trade, this is, you take profits at major milestones. 40 is a major milestone. 45 is a major milestone. 50 is certainly a time when I'd say, look, if I had anything left in this and it goes from 32 to 50 in 2 days, I'm taking profits out. And if you didn't, if you tried to catch this like 1 minute when it jumped up on the very opening, of day 3, 54, you got hammered. You lost 12 points in about 30 minutes, watching this thing come down and hoping it's going to come back. And the feeling here, you get kind of desperate. You don't want to sell because you're in your mind, you're like, oh, I could have had that. Maybe it'll come back. And you hold, and then it comes down here, and you're just like, ugh. And then you panic sell down here. It's like, might as well just sold 2 days earlier and use that money in another IPO. So take your profits. Don't regret it.
Round numbers are important. Round numbers are important.
Round numbers on these are definitely important. ThoughtWorks, this one kind of surprised me. I think it just kind of caught the trend of everything, everything was rising in the IPO world. I believe and I hope that we're seeing IPOs that are not debuting at 100% premiums. We're seeing like the strong, solid ones debut at 30% premium, 40% premium, and that gives us some room as retail traders to get in and experience a bit of the pop. ThoughtWorks, I think, caught that trend. It sort of opened up and dropped, came back up a little bit, and it was just kind of bouncing around. And then it felt like the market went, wait, IPOs are hot. ThoughtWorks is an IPO today. Okay. And it just blasted up. And then it carried that momentum. I think it was riding a lot of the trend. I didn't have and I was, fully committed to on by this point. But this one was, did well. And when I start seeing all the IPOs do strongly, I'm going to start, it gives me more confidence to, hey, this trade is working. I want to get in this. Easy fill. This was a low float kind of meme pumped in the stock group. If you're going to play these, try to buy on the lower than the debut and just wait for that one pump. We've seen it on day 1 or day 2. We get one big pump. When it does that, if you want to play this, you're taking a big risk, in my opinion. Buy the dip, sell the rip. Wait for day 1 or day 2 is when we've seen a lot of these run. Take your money out and then forget about it. I don't think this is a strong company. This was the Michael Jordan ringing the bell, Federer backed. It was an obvious day 2 run for me. Bought in on debut and just basically sat it out. I didn't try to take profits here and play it out. I just said, look, I'm going to hold this to day 2 and I'm going to take, at 38.50, I'm going to take my profits and then play the next one, which was my best win of the week. By the time Thursday rolled around, Forge Rock was poised for, a run. It's tech, it's identity, it's cybersecurity, has a pretty low float. And it was just, I took a very big position on the debut, let it ride for day 2, and then just started taking out, I took 1,500 shares, took 500 out here, 500 out here. I got stopped out. I was protecting, 500 on the downside here, and then 500 on the way up here. So we're in the 42 range. So that was an easy win. Now, taking what we looked at last week, we're still seeing IPOs. Yeah, we have a full slate. I'm going to just completely skip through some of these. Yeah. We have a full slate of IPOs. IPOs are still debuting at a little bit of a tentative premium, which is great for IPO trading. We have a day 2 run. Almost all of these are giving us day 2 runs. But we also have a lot of plays. So my strategy is to play as many as I can without taking a loss, stacking up 5-10% wins and rolling my wins into the next one. If somehow this week I can play 4 or 5 IPOs without taking a loss and taking a 10% win on each one or greater, that will compound itself into a very large win total by the end of the week. And when I looked back at my totals at the end of last week, even though I made some mistakes, I missed some opportunities, I still did incredibly well. So the first one is AKA Brands Holding. I don't know much about this. This is a retail brand that, clothing for Gen Z. They have a direct to consumer and mobile first model. So low overhead. Some of the brand names are Princess Polly, Culture Kings, Petal and Pup, and Reb Dolls. I guess Princess Polly and Culture Kings are the 90% of their business. They have growing revenue, gross profits, and gross margins, which are the 3 kind of things that we look for. And revenue was up 166% in the first half of 2021 versus 2020. Gross profit up 170% in 2021 and 2020, and a pretty low float. So the financials are there. I don't know if the brand recognition is going to be there amongst traders. I mean, Gen Z, I don't know how many of them are going to be buying, stock, and I don't know how many of them will connect the dots between AKA Brands Holding and these brands that we're talking about. But I've missed out on some strong retail debuts that are just not in my wheelhouse. I'm more focused on tech and growth stocks, like not necessarily in retail, but we saw Curve, we saw a few others that did really well off the IPO. So This one might be worth dipping a toe in the water, but there's a lot of IPOs on this date and the next date. So I definitely don't want to get caught in anything, and I'm willing to miss or undercut to the entry to try to, take quick profits and move on. Toast. This is one that,
here's the one I want to know about. This is the one that I'm interested in.
I think there's a lot of interest in this because a lot of, especially entrepreneurs, are in the restaurant industry or aware of Toast. It gets a lot of comparison to Square, even though the comparisons are a little bit maybe not completely aligned. But basically, it's payment processing and point of sale for the restaurant industry. So a lot of restaurants are using this to charge your credit card for meals. Everybody pays for their meals with credit cards. And this system, this software as a service, is specifically tailored for restaurants. Now, they got hit really badly at the beginning of the pandemic because people stopped going to restaurants. There was lockdown. But they pivoted really quickly to launch services basically to allow restaurants to run their own delivery services and tie in with, and to sidestep these, Instacart or Uber Eats, these kinds of things, and do it themselves. And we all know that restaurants don't really love the delivery food models or these delivery services because they take such an aggressive cut of their profits. And it takes a key of the, dining experience out of their hands. Customers want their food fast and hot. And if they're leaving it to someone else to handle it, maybe they can do it more efficiently themselves and put those profits in their own pockets. So Toast did pretty well despite the hit. They were still able to grow revenue 23%. In the middle of COVID. They've had 104% growth in 2021 to 2020. And the valuation of this IPO is actually coming in below what they had attempted to go public with in February 2021. The float isn't that high, and I think a lot of people are very interested in this one. I wouldn't be surprised. I've already seen other kind of social stock people who own restaurants talking about this one. I'm looking forward to it. So I believe this one's going to be hot. I want to keep an eye on it, but I do believe that this one is one worth playing, especially if we don't see a super high premium, but it's probably worth playing anyway. You have the right people interested in this, and it has the right, it's certainly poised for reopening and continued lockdown. So it's good. There's just a lot of other really good ones this week. Freshworks is a CRM solution. They have 50,000 paying customers, 11,000 customers paying over 5,000 a year, but they compete with Salesforce, and it's a pretty crowded market. Despite that, they are growing faster than a lot of their peers. They got sales growth up 53%. They're cash flow positive. This float is the only thing that's a little bit kind of like, given how many IPOs there are, I really want to find the ones that are most primed to get a pump. And at 28.5 million shares, this one is like, I like it. I'm going to be very tight with any kind of stop losses because there's so many later in the week that I don't want to have, a big portion of my buying power tied up in anything. And I'm not, I would say I'm pretty high conviction, but not as high as some of the other things I like this week. Sterling Check, this is background screening and monitoring. They are rebounding past in post-lockdown. People are starting to hire again. They need to do background screening. Revenue is still up 43% in the 6 months ending June 30th, 2021. Profit up 42% in the same period. The float is pretty low. This is getting into September 23rd now. So I have to check that one. Yeah. I'm not sure. I will have to kind of feel this out. And if all the IPOs are doing well off the debut and the timing of this one throughout the day, because they don't all go live at 9, none of them go live at 9:30. Some will go live at 10, some will go live at 11, some won't go live until 12 or even 1. So there is an element of schedule that goes into these. And if I can't play them all, I'm not sure this is just screaming at me, hey, don't miss this one. But it does look pretty strong. Knowlton Development, this one's interesting. I had no idea what they were, but they basically develop and produce products for the beauty, personal care, home care brands, basically packaged consumer goods. And they do this for over 1,000 brands and over 9,000 products. So 18 out of the largest consumer packaged goods companies use them as clients, and they basically handle like the R&D, formulation, packaging, design, production, regulation. They kind of like produce the products that other brands then package and sell as their brand. And they have really good numbers. I mean, revenue's up 96% year over year, gross profits up 119% year over year. The one thing that really kind of gives me the is the 57 million shares. I usually like IPOs that are under, around or under 30 million shares. 50 million shares is a very large float for the retail market to gobble up before we start seeing demand outpace supply. So this would really require a bunch of institutional investors, a lot of retail traders. A lot of people need to get in on this after it goes live for this to push the share price up. So maybe this doesn't do badly, and maybe this is a solid company. I'm just not sure we're going to see the kind of movement that I like to see in an IPO debut to take profits.
All right, a couple more minutes here. What else we got?
Okay, we got Thorne Health Tech. This is personalized nutritional supplements on a subscription platform. They're profitable, positive cash flow, net profit. They have free cash flow, strong revenue, strong profits, low float. It's basically nutritional supplements. I don't know. For me, it's kind of like, well, crowded space. I don't know about it.
Yeah, next.
Engage Smart. This is customer engagement software. Is taking market share from their competitors. They're rapidly growing and aggressively against companies like Salesforce and the other one we saw earlier.
SaaS is big.
Revenue up 58%, profits up 61%, swinging to net income positive, and a pretty low float. This is the kind of play that looked like it did pretty well last week, and I sort of like this one for this week. I probably will put it on the very likely to play list.
Okay.
And keep an eye on that one. Sovos Brands, these guys acquire food brands in products that they believe are going to be hot. Michelangelo's, Rouse Homemade, Noosa Yogurt, Birch Benders. I'm not familiar with these brands. I don't live in America though, so maybe that's why. Revenue growth during lockdown, sure. Profit up 28.6. That should be 1%. Low float.
Don't worry, Matt. I live in America. I never heard of those brands either.
Yeah. So these guys make money. It's a company that makes money. Great, but is it really going to stand out in the crowded IPO market this week? If it does, great. But I'm probably not going to play it. Brilliant Earth Group, ethically sourced jewelry that's sold direct to consumer in showrooms, targeted towards millennials and Gen Z. Revenue up 78%, profits up 94%, net income and growing cash. There is some random lawsuit on record that they basically say, look, this is garbage. Some customers said they recorded phone calls with the customer without alerting them. Doesn't sound like anything critical to their business model. Lowish float. I really don't know about this one. It's interesting. Those are great financials. Sure, I think the attitudes in jewelry are shifting. People are even open to kind of like lab-grown diamonds and that kind of thing. But not really, trade what you know. I don't know anything about this. I bought, exactly one diamond in my life, and that was to get,
right.
to,
all right,
proposals.
All right, we got 1 minute left. What else we got?
Yeah, Remitly. This one's interesting, but it's crowded space. They send money, international money transfers. They compete with Wise, Zoom, and others. I'm going to blow through this one. I'm going to send out a newsletter tonight with further details on all these. So sign up for the newsletter at ipowarriors.com. There is one other one or two I want to cover if you give me a minute here. Argo Blockchain. This is an uplisting. It's a crypto miner. What's interesting about this is it's a low float being offered, but there's 456 million shares outstanding. However, a lot of times on these uplistings, we don't see those initial shares or those kind of carryover shares being tradable right away. It's also being offered on Robinhood, which is a 30-day lockup usually. So I've also noticed the price spiked last week above it's trading at $1.80 right now. The uplisting is a reverse split of 10-to-1. So the fair market value should be $1.85. So why did it spike up? Well, we saw this in FCUV about 2 weeks ago. And what it appeared to be was the underwriter and the shareholders were buying up all the shares. On the day of the offering, there was a huge squeeze. There was no shares available, and they just pumped the price up. So if that happens with this one, just keep an eye on it. It's a phenomenon I've been paying attention to. This one's really interested me, Q Health, and we can kind of close on this one. They make COVID-19 tests. They're a digital diagnostic device, and they're going to expand into pregnancy, flu, and other testing applications. And it's clearly catching on. They got huge contracts with the U.S. military and the NBA. They're partnered with J&J, Mayo Clinic, etc. There's no comps for 22 because they weren't doing COVID. They didn't have financials in 2020. But the revenue for this, for the last year, 200 million. Product gross profit of 116 million. Product gross profit margin was 58%, and the float's pretty low. We've seen COVID plays do really well, so I like this one. There is one more, Clearwater Analytics. It's a SaaS investment and management for asset management. Revenue and profits are solid. Not particularly exciting, but when you sell things to investment management companies, they know about this product. If they like it, they'll buy the IPO. But I think I'll be putting pretty heavy play into Q Health given the setup here on the same day, and I like that one better than Clearwater Analytics. So you can't play them all. This isn't Pokemon. You're not going to catch everything. You need to, identify the trades, pick out 3 or 4 that you really like, and focus on those. Watch the others just to learn from what's going on. But we have a great week. Things will look really strong last week, and I'm super excited for what's coming up on the IPO calendar this
Matt
week.
Hammond, IPOwarriors.com. Thanks a lot, Matt. Talk to you next Monday.
Thanks, Spencer. Take care. Bye-bye.
All right, guys, we're wrapping up here. Just to put everything in perspective here today, we are down. First off, we've come $2 off the low in SPY in the last few minutes here. But just to put things in perspective, we're down 4.5% from what? From all-time highs. So, yes, I'm not saying this is nothing this morning. The sell-off the last few days it's not nothing, but let's all just keep that in perspective. We were at all-time highs a little while ago. So, if you're panicking, if you're running for the hills on today, then frankly, you've got too much risk on the table. Take some money off the table, frankly. Just wanted to say that before we're done. All right. How many likes are we at today? 429. Get me to 500 likes. Like us for the, come on, new graphics, guys. It's not every day we do some new stuff on this show. We're trying new things, see what works, what doesn't. So hit that like button for me, please. Thanks to Matt. Thanks to Tim. Thanks to all of you in our chat. Please remember all the information from our show is meant to be used as informational purposes, not for investing or trading advice. To watch David Green live right now, the link is pinned to the top of the chat in YouTube. You can also go to youtube.com/Benzinga. This stream will end. It will not redirect you to David Green. So just click on the link in chat or go to our YouTube channel, or as always, we're also on Twitch and Twitter on Benzinga's platforms there. That's going to be a wrap for me. David Green live right now. We open in 2 minutes. Everyone have a good rest of your day, and we'll see you later. Nice job, Mitch.